Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
And welcome to today's podcast, or this episode, I guess. There's a lot of you that are binge listening, and kudos to you, because I can't listen to myself that long, but if you can, I appreciate it. But welcome to the podcast again, and the new episode. So today I want to talk about taxes. I am actually really quite surprised I've never addressed this before, because it's something I talk about constantly. But apparently, I've never thought to do a podcast on it. So, hey, before we get there, though, if you guys would please share this podcast with other people or go on Facebook. If you are a client or just like what you read or whatever, go on Facebook, leave a review, same thing on YouTube, I guess. This all helps, so I'm told. I'm just here to provide some information, and if you like it, great, fantastic. But let's talk about taxes and the language and how we need to correctly use the policy. And, this is probably one of my biggest pet peeves, is that most agents don't know what the heck they're doing. They're using the wrong terminology, hence why you don't want to just generally use another agent. Now, if you are listening to this podcast so that you can use another agent because they don't know what they're talking about, don't come back to me and say I did something wrong, because you're not working with me. And let's just keep in mind, every situation can change the scenario. So if you're a life insurance agent and you're listening to this to get information to use for your clients, why are you not actually being mentored by somebody and not part of the institute and not teaming up with your own accountant? I am not an accountant and I am not an attorney. So I am not going to I know enough to share, and that is it. If you are taking everything I say as gospel and not checking back with your accountant, God help you. I mean, you guys, I would never mislead you, but I'm not the one doing taxes. So please, after you listen to this episode, make sure you are going back to your accountant and verifying. Tax law changes all the time. And I'm recording this in 2020, November of 2020. So make sure that you are constantly looking at those things. Okay, life insurance. When we talk about the cash value, let's address cash value first. Some people will say, the cash value grows income tax-free. We should be using the term deferred. It grows tax deferred. It can grow income tax-free if you use it correctly, but there's different ways to use life insurance. Let's say that your cash value is $300,000 and the premiums you've paid are $100,000. Your accumulative premiums that you have paid in over the years is called cost basis. Okay? If your cost basis and your premiums paid in total $100,000 and you have $300,000 of cash value, if you take out $300,000, if you do a withdrawal, people always say, I'm going to take out my cash value. Okay, that's a withdrawal. If you take it out, you're withdrawing $300,000. You are going to pay income tax on $200,000. You took it out. If you take out $100,000, there's no income tax to be paid if you did not MEC the policy. Okay, this is all a no mech. If you mech the policy, the rules change. If there's a no mech and you take out 100, you're good. No income tax. If you borrow against the 200, no income tax. It's borrowed money. It's borrowed. You took a loan. Two very different things, yet people don't use the right language. I have had clients call the insurance company and say, I want to take $50,000. They took it. They did not do a loan because you didn't use the right terminology. I will correct clients, and I'm not correcting them to be arrogant and to be rude. I'm correcting you for this very reason, that if you take money above the basis from cash value, you can't put it back. You took it. It's like taking money out of a savings account. You took it. It stopped earning interest. It's no longer in cash value. If you borrow against it, now you can pay it back. It continued to stay in the policy, earning the uninterrupted compound interest and dividends. Again, depending on the company you use. Not all companies will pay dividends if you borrow against the money. Mine does. Okay? This is extremely important. That money is growing tax deferred until you take it out. And the reason this is super important as well is because I have had a run-in with an accountant who thinks that he knows everything. Just as I just told you, I don't know everything about taxes. Those guys don't know everything about life insurance. And so instead of referring you to a professional, they tend to not. So I had a run-in with an accountant who said, I bought one of those things and it didn't work. Okay, I looked him up. He was actually a life insurance agent, obviously, when he bought his. He bought a universal life. Clearly didn't know what he was doing, right? Chasing rates of return. Bought a universal life. Took the money out when he needed it to pay for expenses. Couldn't put it back in. Was taxed on it. For heaven's sakes, I would hope he would know the difference between a loan and actually taking it out, but he clearly had no idea what he's doing. So he's telling everybody that runs into him not to do this. But he himself was not. He was ignorant, to say the least. Am I irritated about it? Yes. Not because I lost business, but because he is not educating himself, chooses not to, and chooses not to talk to me. And so you can't take it out. It depends how you use it. And if you use a universal life policy and index to variable, it doesn't work the same because it's not whole life. And so he was missing the mark on many points. Let's get the terminology correct. Okay, that's cash value. How we use that cash value is important. Taxes, paying premium. Can the premium be expensed? No. You cannot have an operation pay for LLC, pay for the premium and expense it as an expense. The LLC can pay for it. The corporation can pay for it, but it cannot deduct it as an expense. Okay? Or you give up the tax benefits on the back end. I pay my premiums. I do not expense them. They come to me as a distribution. That is how they are coded in my books. Death benefit. Death benefit comes to you income tax free. It may not be estate tax free. So for those of you that don't know what estate taxes are, your land, your equipment, your home, your investments are all added together, and that is your estate. Okay, that's your estate value. Or net worth, I suppose some people will call it. I don't know that that's interchangeable in the tax code. An accountant question. I will digress to the accountant. I don't know that those are interchangeable. But if your estate is above a certain value and death benefit is included in that estate value, you are going to have to pay estate tax. I don't know off the top of my head what the estate taxes are today in 2020. I'm going to guess at about 15%. Guessing, not certain. Okay, so let's say that you have an estate taxes today in 2020 are $11.5 million. So we went from, in 2015, the estate value was $5.4 million, meaning if your estate was over $5.4 million, you got to pay tax on anything above the $5.4 million. When we changed administrations in 2016 or 2017, I'm not sure when that estate value changed, but when we changed administrations, the estate value went to $11.3 million. And I just looked it up. Every year it's going up. And so in 2021, it's going to be $11.7 million. If your estate is over $11.7 million, you have to pay estate tax. If it's under $11.7 million, you're not going to pay estate tax. So if you have a death benefit of $7 million and the land and and everything else you have puts you over $11.7 million, guess what? You're going to have to pay estate tax on that death benefit. It's going to qualify as estate tax, or to pay estate tax, but not income tax. Now, a lot of people are like, well, 11.4, 11.5, 11.7 million. Geez, I don't have anything to worry about. Okay. Every administration changes this estate tax. Every administration. And so will we go back down to an estate tax of 5.4 million? Or I think at one point when I started teaching infinite banking years ago, I do believe we were at like 3.1 million for an estate tax, or for estate value. And I don't know, I don't remember exactly when that time frame was. But if I do remember that. So if we were at 3.1 million, now we're at 11.7, people are like, oh, it's no big deal. Well, it is a big deal when I have clients who have a lot of death benefit. And that could throw you into an estate issue, an estate tax issue. And so if you are a young person who has a lot of death benefit, we need to keep track of that as you get older. Well, you need to keep track of it as you get older, because I don't know what your estate value is every year from year to year. You need to pay attention to estate tax and what that moving target is, so that if you pass away or somebody passes away within that year, are we going to have an estate issue? Now, I had an attorney who, again, did not understand life insurance and was using it as an estate tool. And he said, we were talking about borrowing cash value. And he said to me, oh, we could just borrow cash value or take out cash value to reduce the amount of death benefit to fall into a lower tax bracket for estate taxes, right? So maybe if we have so much death benefit that it throws our estate value over that 11.7 million, can we either borrow against some of the money, because then when we die, it reduces the death benefit, or can we take it out? And then it's going to reduce death benefit. So can we take the cash value or borrow against it to reduce death benefit to reduce estate value? And so he had not thought of that before, but that came from the estate attorney. So I'm assuming that is going to work. But again, talk to your accountant and talk to your attorney. And so if we have a life insurance policy that we're going to have to pay estate taxes on, what do we do to get that out of our estate? And you might need to change ownership on the policy. You might need to create a trust that still allows you access to cash value. Okay, some trusts do not, according to my attorney. There are trusts that do allow you access to cash value so you can keep using it, but that trust then separates it from the estate. And we are not subject to estate taxes. So consult with your attorney and make sure, okay, I've got this life insurance. I don't want to give up access to cash value. I want to be able to borrow against it and pay it back. However, I want it removed. And if we change ownership on a policy, is there a look back period to do that? What happens if the owners, the current owners, aka mom and dad in this situation, continue to pay premium, but we're the owners? Does that qualify? Like, you got to ask these finer details if you're going to try to avoid estate tax. But when we are selling large amounts of death benefit and you have a large estate as well, or you're going to in the future, if you have, $1 million, $2 million of death benefit today, okay, no big deal, right? But if 15, 20 years down the road, you buy more life insurance and we have more death benefit between you and your wife, it's not just your estate, it's between you and your wife. You each get, in today's world, you each get 11.5 million or whatever it is today. And so the other thing is when somebody passes away, let's say the estate tax is 10 million for easy numbers, or the estate limit. I'm sorry, I keep saying tax. Let's just say that the estate limit is 10 million and you pass away. Your spouse, if your estate is only 5 million, your spouse can do, I don't even know what it's called. It's some number code for tax code. And she can absorb the 5 million you did not use, which would then put her estate value at 15. And so she can move over any unused portion. A lot of times I have seen that this does not get done because, we didn't have enough. It's not a big deal. Well, it is a big deal if that carries through and is grandfathered in from one administration to the next. And so make sure that you're talking to your accountant about that. I am sorry, I do not know the code of what that is. I just heard about it from a client who it didn't happen on. The accountant did not file this form, and then mom there were massive estate issues for mom that could have been avoided if the accountant had done their job. But at that point, the estate value was really high and it was no big deal. However, it changes. So we need to think ahead, people. Think long-term. So I clarifying all these tax benefits and incentives and loopholes and all this crap we always hear about in the life insurance world, and making sure we really understand that death benefit is not tax-free. And I hear people say that a lot. Oh, the death benefit's tax-free. No, it's income tax-free, and it may not be estate tax-free. Cash value grows tax-deferred if you take it out, but you can use it tax-free if you borrow against it. Premium is not an expense, right? We're paying taxes up front on that income that's going in. Yes, we can borrow against the cash value, and according to my accountant, we can write off the interest if we used it as a business expense. You better have paperwork to back that up. And you have to track all that. You got to track it all. Make sure when you are talking to your accountants and your attorneys that you are giving them the full picture and not just saying, yeah, I got some life insurance. Okay, how much? Is it going to be an estate issue? Make sure you're keeping track of that death benefit. I hope that clarified a lot of the tax questions. And again, I don't know why I've not brought this up before because I talk about this nonstop. And I clearly thought I had done a podcast on it, but I didn't. So here it is, my friends. Here it is. Okay, let me know, you guys. That's sums it up. I don't have a lot more on that topic. Unless you have questions, then please email them. maryjo@withoutthebank.com, and I would be happy to answer those for you. If you have not gotten the book or scheduled your appointment, please do so. Get on the calendar, get that book read, get it ordered. And I just had someone tell me today that the podcasts are more beneficial than the book. That's fantastic, and I am happy to hear that, but you still have to read the book. You still need to read the book. And please read Nelson's book as well. You can get them as a bundle on my website, farmingwithoutthebank.com. And if you'd be so kind as to leave reviews about how awesome I am, I would very much appreciate it. Okay, guys, you have a fantastic rest of your day, and I will catch you here in the next episode.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.